Hey guys, welcome to this week's Money and Investing show. This week we're tackling the subject of inflation. What is it? How does it work? What's its impact on you? But perhaps most importantly, where are the investment opportunities? See you in the show. Hey there guys, welcome to this week's Money and Investing show with me, your host Andrew Baxter, and as always my co-host Mr. Mitchell Laurential.
Thanks for having me on the show, Mr. B. Pleasure to be here, and to pump up some ties or some air, however you want to call it, let's talk about inflating, and let's talk about inflation more specifically in the economy.
Very good. Okay, well, inflation in the economy is something you can't live with, you can't live without, and is a very important thing to understand, yet so few people really appreciate the significance of it. So what have you got for me?
Double-edged sword, I think. Inflation, it can be used for you, and it can also go against you quite heavily. Us consumers, obviously, we hate prices going up, but ultimately it has to happen. And I guess that poses the question as to what actually is inflation at its core, as its core definition.
Okay, so inflation, you can use a lot of different everyday terms, but if you wanted to simplify it, it's effectively what prices increase by over time. You know, things used to be cheaper in the past, more expensive in the future. That effectively is inflation. It's measured using a statistical measure called Consumer Price Index, or CPI, which is one of those headlines that you see thrown around. Not necessarily the best measure, but it's what it is. So we can probably explore a little bit about that and how it's calculated, and what constitutes good inflation and what's not so good.
Sure. So if we use the example just to sort of flesh that out a little bit more, if the CPI in 2020 was, let's say, 2%, does that mean prices have gone up exactly by 2% on average?
Yeah, so CPI is a calculation based on a basket. This is important to understand. What the calculation is based on is to say, okay, let's look at what households spend their money on. We put it in like a shopping trolley basket type thing, and then we'll look at the price of what that was last month versus what it is currently, and use that as a benchmark. Of course, the question is what goes in that basket, because it can actually be a little bit misleading and not necessarily pick up all the things that it should.
Well, let's explore that. Why is it misleading? And I know you and I have chatted about, say, house prices versus rents.
Yeah.
Let's go through that.
Okay, so at the moment we're sitting in Australia where we have an absolutely rampant property market, long way it continue.
Rampant.
And what we're seeing is capital prices of property going up virtually everywhere. In some places, I live in Byron's, up 35-40% last year. It's bonkers, the growth that you're seeing. And obviously, as a household, if you want to live somewhere, you've got two choices. You can own or you can rent. If you're an owner, the cost of buying a property is not included in inflation. The cost of renting a property is. And there's a bit of a misnomer there, and apparently the reason is that buying a house is an asset, and assets aren't included in the CPI calculation, but rent as a regular expenditure is. So in that respect, it's extremely misleading. And if we look at the figure for Australia at the moment, it's 0.9% on an annual basis. So prices at the moment are about 0.9% higher than what they were last year. But I think if you had the conversation with Joe Bag of Donuts, your average man on the street, and said, how does it feel? Does it feel more expensive now or less expensive than a year ago? And if you look at some anecdotal evidence, take petrol, for example. Now, I filled my car up I know it was Easter, Monday before Easter, $1.94 a litre.
Oh, that's
I don't get many litres out of my car either. So it's like, whoa, that's pretty expensive. And if you look at petrol prices per se, buying fuel for your vehicle, weekly, fortnightly, whatever it may be in your household, is one of the single largest household expenses. And we've seen prices really drive up quite high, particularly through the volatility in the petrol cycle. That's one thing. Talk about healthcare, and we've seen, 8 or 9% increase in the cost of private health cover. And you could argue that it's about COVID. I don't think it is. I think it's just an opportunity to ratchet prices up. And you've seen, which is manifestly higher. And again, for a lot of households, that private health cover of anywhere between, say, $1,000 and $3,000 a year is a fairly substantial point of expenditure in your budget, and that bites. So to see that headline inflation is only going up at 0.9, yet we're seeing house prices go berserk, fuel prices massively high, private health cover going through the roof, and not many shops have got sales on. Take Harvey Norman or JB Hi-Fi, there aren't sales at the moment because consumer activity is so strong. We're seeing full prices for everything. I don't know. I think there's a big difference between CPI and the real cost of living that's out there, and that's important to understand.
It's a great sort of rundown, and it poses the issue as to why haven't we seen wage growth at the same level? Because wage growth really hasn't had much of an increase whatsoever in the last 5 or so years here in Australia, yet we're seeing the cost of living go up immensely. Why is there such a disconnect?
Look, and this is really important to understand, and you're quite right. If you take the sort of preceding 4 or 5 years before COVID, there was not really any real wage growth in the economy. Low, 1, maybe 0.9 to 1.5% wage growth, not 3 or 4% wage growth. And wage growth is very, very important because when people earn more, they're able to spend more. And one of the big issues with property right now is property and the affordability is becoming very, very stretched. If you don't have wage growth, the ability for people to afford a property starts to get really, really stretched. And you get a huge imbalance within the economy between people that are in or out of the property market, the haves, the have not. And it can be through choice, but oftentimes it can also be through pricing. So it's important to understand. So that lack of wage growth is key. Secondly, a lot of wages and rents, for argument's sake, are also linked to inflation. If you think about commercial rent, it's normally the average, the annual CPI increase on your rent, or 2.5%, usually the greater of the two. And so if you've got properties moving up massively in value, but rent is only increasing at, say, the CPI rate, and wage growth isn't there to support more hikes in rent, you end up with a very, very overvalued property market, which is not good news for anybody that's caught on the wrong side of it.
It's funny you say that. Did some research just last week on one of our weekly classrooms that found a statistic that homes are actually about 39% overvalued at the moment. Interesting statistic.
It is, and it's such a huge stretch of that elastic band, and it will snap back at some point. But today's podcast is not about property. It's about inflation. And that lack of wage growth is a very, very important thing to understand, because genuine growth within the economy, some inflation, and don't get me wrong, inflation is important. You have to have some level of inflation. And I think the RBA target rate is between 2 and 3%, which is about right. If we look at inflation in the US, it's sitting about 1.7%, 0.9 here in Australia at the moment. The RBA's target is between 2 and 3%. Why would they have such a target? Well, you need prices to be increasing, because it shows that your economy is strong and there's a demand for goods, and that supports prices moving higher. To have that, you need two things. You need a workforce that are employed, and we've got fairly low unemployment now. It's at 5 and a bit percent. The RBA's target is about 4%. And that in itself is probably noteworthy. I mean, if you're in business, anyone listening to this podcast or watching this video today, if you're in business and you're trying to recruit, how hard is it to get people right now? And apparently there are all these people looking for work, but they're not really looking for work, or they're not showing up for interviews, or they're not that keen to get in the job market. And I talk to a wide range of my peers and people I have dealings with in different areas of life. Everybody's got the same challenge. They cannot get staff right now. And maybe that's because wage growth hasn't gone up and people aren't earning what they think they should be earning, which is one factor. Or maybe there's not enough pain to get back in the workforce. That's a totally different conversation to be having. But if you've got a more full employment, 4% being the RBA's target, I don't see that a move down from 5 and a bit unemployment to 4% unemployment is all of a sudden going to create wage growth. Maybe you've got to pay more to attract talent, or maybe the people that aren't working simply don't want to work. Probably won't get a bit of hate mail for that comment, but that seems to be the anecdotal view when you're trying to hire at the moment.
Yeah, we love hate mail, so bring it on, is what we say.
So got to have wage growth. Having prices moving higher is good, because there's an incentive for people. Prices need to move higher, not too quickly, I guess.
Sure.
So some price hike, but not too much.
Okay.
And the idea of that is that if prices are moving up, there is an incentive to take action now. So if you're going to buy something, better to buy it today, because it'll be more expensive next week. So there's an incentive for economic activity to happen, which keeps your economy moving. If you get the opposite of inflation, which is deflation, that is a disaster zone economically, because prices are getting lower over time. So you say, okay, you want to go buy a new fridge or a new stereo or a new TV or whatever it might be. Don't worry about doing it today, do it next week, it'll be cheaper. In fact, hang off, don't even do it next week, wait till next month, it'll be cheaper again.
Isn't that great for the consumer though?
Not really, because no one ends up spending, because they're all looking for the next best deal and they're waiting for prices to drop. Slows down sales, slows down turnover in business, slows down economic activity. And that's why having that fire burning a little bit is absolutely crucial, but getting the balance right is key. And I think we're in for some tricky times ahead. With interest rates being as low as they are. And if we look at the US as an example, interest rates have been lower for longer. And this, I appreciate, is maybe reasonably technical. It's about economics, which isn't that exciting. We'll get on to how you can profit from this in just a few moments. But I do think it's important to understand what's on the cover of the jigsaw puzzle box, so you can see the picture that we're aiming at here. So we look at the US, interest rates have been lower for a lot longer. You've had interest rates effectively almost negative there if you look at the bond market, going back 6-12 months ago. And as a consequence, there's a huge volume of money pumping into that economy to stimulate it, and you're starting to see inflationary pressures build. Some inflation is good, but once the genie is out of the bottle, you've then got to try and rein it back in. So if you get rampant price hikes, that's a real problem too. You've got to try and keep a lid on it. It's such a fine balance that central banks have to deal with. And I think in Australia, with the commitment that our central bank, the Reserve Bank, have made to say, we will not move interest rates up until 2024 is a very, very dangerous statement to make. Because you're saying it doesn't matter what the economics say, we're not moving on interest rates. And I think having very low levels are resulting in this extended property market that we're seeing right now. And sure, interest rates are low and you think it's good for business confidence, but business borrowing hasn't increased that much because there's too much uncertainty out there. So it's not gone into the job market to create that. It's just been cheap money that people have been able to borrow to buy property or buy goods and services, which we've seen with consumer spending going through the roof. Very dangerous. This could pop. You've got a big inflation problem.
It really has been the buzzword too. The whole notion of inflation, especially in the US with bond yields, the NASDAQ, valuations of future earnings and whatnot. It's really caused some havoc on the market, especially a couple of weeks back. We saw the NASDAQ really sell off due to that. And I guess that poses the question as to why is it so topical and why does it have, if it's mainly economical, such an effect on financial markets?
Oh, there's a big question, hey? And probably the most important question. Thanks for loading me up. When we talk about yield, we can talk about capital moves on an asset. A share price can go up, a house price can go up, bond prices can move around, but it's actually the percentage return income, which is what we call yield. So if we take the earnings on a share and divide it by, or the dividend on a share and divide it by the share price, that gives you the yield. It could be 3.5%, 4% a year is what you're getting paid as a yield, as an income from owning that share. If you're in property, if you take your rent and divide it by the value of the property, that effectively is giving you your yield. Obviously, you could do that on a gross or a net basis with property, depending on your finance and so on and so forth. Massively different number. If you're talking about bonds, the coupon, the income you receive from the bond divided by the bond price gives you the yield. And yields are very, very important to understand. Not overly exciting, but very, very important to understand. And if you have a situation where inflation is starting to gain momentum, as we've seen in the US, the view is then that, okay, if inflation is starting to go up, when inflation rises, so too do bond yields. Okay? Now, if bond yields go up, bonds all of a sudden can start to look relatively attractive because they're paying a higher yield than what you might be getting from your shares.
And they're less risk, right?
Lower risk, and as a consequence, you see money flowing out of the share market, the equities market, into the bond market, chasing a higher yield for a low level of risk.
And we saw that periodically in the US, where bond yields were actually ticked up higher than what the average dividend yield on the S&P was, right?
And look, in all fairness, the dividend yield in the US is relatively low compared to Australia. They're different markets. US companies tend to be more growth focused, where they have smaller dividends and reinvest in the business. In Australia, we tend to pay our shareholders more. But that is a very, very important fundamental point. So when we saw that sell-off in markets, it was because in that moment of time, bond yields definitely were outstripping the equity market yield for a low level of risk. So money is going to flow from one place to another very quickly, and that's what effectively caused that sell-off. Now, of course, with share prices falling in a sell-off, then the yield goes back up and equilibrium is re-established again.
Okay, so to play devil's advocate here for you, that's
going on with this.
There's a lot going on, and certainly our listeners have the benefit of going back and re-listening to this. Now, if the Fed or the the Australian government, if they've got a target to increase inflation, so we're at 0.9%, we want it to be between 3 and 4, as you mentioned. If we increase inflation and that causes equity prices to sell off, isn't that bad?
Well, it's interesting, isn't it? The RBA's job is not to steward share markets any more than the Federal Reserve's job is to, you would think, not steward through the share market as well. Yeah, they have as an independent body, and I'll put an asterisk after that, and you can say what you like thereafter. But as an independent body, their job is to keep the inflation target within a range, specifically 2 to 3% here in Australia. Now, that can come at certain costs. In that effort to get the inflation level to there and maintain it there, you can have a dramatic impact on unemployment. You can certainly, as we're seeing in Australia, have a dramatic impact on property. Our property market has been running pretty hard for the last 4 years, 2017 post-election, since then through to the start of the COVID time frame. Australian property was running pretty hard. We had the pause and the potential collapse at the start of COVID, vacancy rates going through the roof in the CBDs, in apartments and things like that, and still being actually relatively high. Vacancy rates actually very, very high in Sydney, Melbourne and CBDs, because people have moved out, different areas, out to the suburbs, so forth, so on and so forth. But then what you've seen is this resurgence in property, and it's getting to the point where it's out of control. And that is a real problem, because as soon as interest rates are moved up, which at some point they will have to be, and whilst the RBA may be resolute on not doing anything until 2024, I don't know that they're necessarily going to get to make that decision. If inflationary pressures continue to build, I've just done a build. I'm looking for a new site for another development right now. Just in timber costs to build a house, timber costs right now are 15% more than what they were this time last year. Ooh. And part of the reason for this is because of everything you can blame COVID for, I suppose, the COVID supply chain.
Sure.
And as a consequence, 15% more is what you're going to pay for the timber. Now, timber's the primary cost in building a house if it's a wooden framed house. And so there's a hidden cost that's pushing through on that inflationary side yet again. This is a major problem. Add to that, a property market that's literally gone off to the races. Will the RBA need to move? I think they're going to need to. They need to do something. Whether they don't put interest rates up, maybe they increase APRA's guidance to banks to say, look, you can't lend at 20%, you've got a 30-40% deposit to try and slow it down. Something needs to happen, because if you let this thing run away and there's no wage growth following in behind it, when things correct, which they will, a small move in interest rates over here on a very leveraged position without any wage growth sitting behind it is a catastrophic recipe for people that have bought into the market at the heights. And you go, you ride it out. How? If you get a substantial fall in the property market, you may need to top more into your account, so you don't have a negative equity balance, for example. Rents aren't growing because there's no wage growth to really speak of. How do you service the debt becomes a problem. Negative gearing is great as long as you've got a big tax problem. All very nasty. So this inflationary figure is why we focus on it so much, and it's why the RBA is obsessive about it, making sure that it's in its bands. So that's in a nutshell a little bit about how inflation can kick things around. Obviously within that, there are massive investment opportunities too.
Yeah, how do we play this? Let's first chat about what it means to trade inflation and then also to invest in it, because you can be on either side of the fence, right? Yeah,
I mean, it's something that's going to happen for the reasons that we've talked of. At some point, if you keep pouring fuel on a fire, your matches might be a bit damp, but at some point when it's not lighting, I'll put more fuel on the matches. When it goes, it's going to go. Okay, so it's going to happen at some point. So how do you trade and profit from that? During times of inflation, real assets tend to grow in value. We've talked about property, and that's what I'm saying. If inflation is so low, how is property pushing in the way that it is? There's no real basis for it other than FOMO and a euphoria, and that's a very dangerous thing. I liken it to the tech sector in the sort of late 90s, early 2000.
The bubble.
Yeah, the bubble. There's that element behind it. But perhaps more importantly, other assets like gold, for example, have traditionally been seen as an inflation hedge. In times of inflation, you buy gold. I think the new gold, and you can hear this come out of my mouth, as you know, is probably going to be crypto as an inflationary hedge, just because it operates as an independently correlated asset outside of the traditional world. And if you've got inflation, you've got a very good chance of having a good inflation hedge with crypto. So gold, crypto are two examples. Property is another one. In times of inflation, the stock market tends to do quite well. Why? Because they're real assets. If there's inflation, it means there's lots of economic activity. Lots of economic activity means companies make lots of profit and the price moves up.
So is there a way as a trader to gain exposure to the upside on inflationary pressures in the stock market as such?
You can look to trade stocks, which is a fairly blunt instrument, because you've got to be able to find the right kind of stocks. Some stocks perform far better during inflationary environments than others. So for example, the banks typically would do very, very well in those circumstances. If you look at retail, it would typically do very well in those circumstances. And some of the more defensive type plays, your Telstras, for example, your Horizons, things like that, they tend to do less well in those sets of circumstances. Okay, so you've got to be fairly stock specific. For my mind, the purest play is to say, okay, there's no financial instrument, well, there probably is somewhere, but there's no real financial instrument that's a direct play on inflation. So we've got to look for a proxy, something that reacts in the same or a correlated way to that. And trading bond yields, I think, is probably the purest way, because if you have inflationary pressure, bond yields go up. Okay, that's a correlation between them. So how do you trade bond yields? Well, you can trade in bonds. Not the easiest thing to do as a retail investor. You can do it, but it's not easy. You need a decent amount of coin to do that. So instead, my go-to instrument, I might tell you after the podcast. My go-to instrument in that is, for example, this is one of many, TBT in the US, which is an exchange-traded fund. And what TBT is, and again, this has been quite a technical podcast, but what TBT is an exchange-traded fund that invests in US Treasuries. And effectively, it's a short play on US Treasuries. In other words, if bond yields go up, US Treasury prices go down. That's the relationship. They're inversely correlated. So if you've got inflation moving higher, bond yields are going to go higher, and TBT is going to fall in value. Bond prices are going to fall in value. TBT is an ultra short US bond prices, and therefore if bond prices fall, TBT goes up in value.
Sure.
Now that would be my go-to very tightly correlated play. There's a lot going on. Inflation's got to be going up, meaning bond yields will rise, meaning bond prices will fall, meaning an ultra short on bond prices is going to go up. And if that doesn't make any sense to you, reach out. We can explain it with the whiteboard, whatever. But that's my go-to play in times of inflation. Very, very lucrative. We saw, just in the time when the Nasdaq came off, we saw TBT put on close to 25% gain over about 5 or 6 days of time. So it's a very good responsive instrument to use at that time. So that's my go-to play.
GovT is another one too. GOVT, that's long bond yields, I believe. Yep. So it works much the same, just a little bit less confusing as such.
There you go. Make it simple. That's what it's all about. I like that. So GovT or TBT, 2 places to play. You can do options over TBT too, so you can get some income, do a cover call over it. Happy days.
Great. And look, we can certainly teach a lot of our listeners how to do that, AB. So as we come to the end of the broadcast, there's certainly been a lot in this to unpack and very, very technical, as you mentioned. What are your final parting words here to cap this off? Don't
get caught up in the jargon. I'm an economist by qualification. I've also been trading for 30 years. So this is second nature to what I do and how we help our clients. So please don't get bogged down in the technicalities of this. Understand that inflation isn't just a headline. There is something behind it. It's also a very deceptive, in my opinion, and misleading headline because it doesn't necessarily reflect the real cost of living that we're in. You go and buy a case of beer, and I'm using some petrol. Go for a coffee, private healthcare, your rent or your house price, add in a slab of beer. You go to Dan Murphy's, you're paying $70 for a slab of beer. Now, don't tell me that prices are not going up when you see that. And you could argue, that's the glass tax because it's a glass bottle, which is where everything's in Canada. There's always a story behind it. Understand that CPI or inflation measures a fairly narrow 1,000 or so items that households spend their money on. And it isn't necessarily a true reflection of what's going on. So that's going to be a shadow of what's going on in the real world, which I believe is why we see inflation as measured by CPI at 0.9%. In reality, it's probably closer to 2 or 3%. The RBA wants CPI to be at 2 to 3%, which means the real world costs are going to be significantly higher.
Crazy.
If you don't have wage growth following behind that, there's going to be a lot of pain, the haves and the have-nots. If you haven't had wage growth, life is sort of stretching away and becoming increasingly unaffordable, just as the property market is for a lot of people. We're also seeing that the rents, and these are all related to this, rents might be creeping up, but they can't keep up with the rampant growth in property. If you get a 40% growth in property prices, you can't jack rent up by 40% because there's no wage growth to support that, simple as that. These will all have an immediate and dramatic knock-on. If you see inflation jag up, you're going to see equity markets stutter, as we've already seen, and that will continue to happen. Jag up in inflation, we're going to see equity markets sell off until balance is resumed in there. When that happens, you go to play, GovT, thanks for that, or TBT are giving you a couple of plays that you can then take out to profit from that move up in inflation. This is not basic stuff, and normally in Money and Investing in our show, we keep things fairly meat and potatoes, and when you challenge me with our title today, we're going to talk about inflation, it's like, okay, how can we make this meat and potatoes that people understand? Because it's a simple thing, but it's so far-reaching in its consequences that you kind of have to look and think and see in 3 dimensions to understand what's going on here. Don't get buried in that. Understand that with low interest rates, inflation will kick in. When it does, you're going to see a slide in equity markets, but what you'll also see is an opportunity in stocks like TBT or GovT to get a profit over there. That's why it's important to be nimble. That's why it's important to be educated to know, here's some news. Join the dots to the trade and join the dots to your bank account and make some profit. And if you put it in really simple terms, that's what we're talking about. Inflation, there's the trade, there's the profit.
And that's what we're here for. Thank you very much, AB. That's a great explanation. Great way to finish that too. So thank you very much.
Always a pleasure, Mitch. Thanks very much. There you have it, guys. That's inflation. Make sure you like, comment, subscribe. Most importantly, hit the notification button to keep up to speed with what we're on. See you next week.